The markets are tanking today. Whatever you do, don't panic. I'm not panicking, and neither should you. Why am I not panicking when the market's tanking? Because I'm not checking the market. I'm doing something that I call mental hygiene. In the past 100 years, there have been more than 14 stock market crashes. The worst thing that you could do after one of them is panic. If you wanted to sell, the time to do that would have been a few days ago, or before Trump got inaugurated. Now it's not a good time because if you're panicking when everyone else is panicking, it's not going to be good. There was a famous writer called Nassim Taleb who was a trader on Wall Street, and he said if you're going to panic, panic early. When you do it when everyone else is doing it, it's way too late. In 2008, when you first heard about the banks being in trouble, if you had sold all your stock then, you would be great. But if you sold when everyone else is selling, then by then it's too late. If you smell smoke in the theater and you run for the exit first, you're fine. Maybe you get outside and it turns out that it wasn't a fire, it was just smoke. You're still fine. But if you just ignore it and wait till everyone else runs to the door, the worst thing you could do is run for the same door because you're going to get crushed with everyone. Stay calm and think of another option. So why is everyone panicking now? In a previous video, I talked about how stupid tariffs are and how stupid people are who think tariffs are great. If you look at this chart, it's a chart of unemployment from 1900 to 1947. If you look at the big spike there, you might think, oh, that's the Great Depression, wasn't it? That's correct. And you might think, well, that was caused by the stock market crash, wasn't it? That's incorrect. The stock market crash was here. And if you see it went down, the stock market crash happened in 1929, which is right here. The stock market crash happened in 1929, which is here. This all happened after. So why did unemployment go up so much after? It was something called the Smoot-Hawley tariff bill. And they were massive tariffs on every country that did business with the United States. Sound familiar? Somebody should have told Trump about this a week ago. But now that everyone's panicking, the worst thing you could do is panic along with them. Unless you need money in the next year, panicking is probably a bad idea. Over the long term, markets go up and down, but you're better off consistently being in the market than trying to time the market. Here's an example. This shows some returns. This is from Hartford Funds of different strategies. And one of them is you are fully invested the entire time. The next one is someone who tries to time the markets, and they were invested almost every day from 1995 to 2024, just like the person who was fully invested all days, except that this person missed investing during the best 10 days of the market. Just the best 10 out of those 20 years. Just the best 10 out of those 30 years. And this guy missed the best 20 days, and this one missed the best 30 days. So if you had consistently invested your paycheck every week, then you would have $224,000. Under this strategy, where you're fully invested the entire time, if you invest almost all the time, but you missed the 10 best days, you would have gotten less than half as much. And if you missed the best 20 days, you would have gotten a lot less. And the best 30 days, you would have 83% less. So instead of 224,000, you would have gotten 38,000 just by not sticking to your guns and consistently investing over time. So when you get your paycheck, a certain amount goes to rent, food, and then a certain amount would go to invest every month. And that's called dollar cost averaging. And why does it work so well? Because there's times when the market is undervalued and there's time when the market is overvalued. And if you're investing a consistent amount over time during the times when the market is overvalued, because you're investing the same amount, you're investing less in each company, fewer shares of each company. And when the market is undervalued, you're getting more shares of each company. So you are investing the same amount, but you're buying more shares of something when it's undervalued, and you're buying fewer shares when it's overvalued. And over a long time, that is a great strategy. This is an article. This is from CharlesSchwab.com. This is an article about different investing styles. There's people who think they can time the market, and you never find any billionaires among that sect because it is not a skill that is teachable. It is not a skill that is repeatable. If it was, there would be a lot more billionaires that got rich during that strategy, but they're not. So assuming that there was a person who knew how to time the market perfectly, we'll call that guy Peter Perfect, and he only invests when it's at the bottom of the market. And then we'll look at Ashley. We'll look at the second strategy where she invests her cash on the first trading day of the year and then does nothing the rest of the year. And then we'll look at Matthew Monthly, who takes the same amount, and instead of perfectly timing the market or investing on the first day of the year, he invests a little bit a month for 12 equal portions over the year. That's the dollar cost averaging that we saw on the previous slide. And we'll see how the results are with the perfect timing. And again, there's no one who does this because you don't have a time machine like in Back to the Future where you can predict the top of the market and the bottom of the market. And when you get to the bottom of the market, nobody rings a bell to let you know. But if you had invested with perfect timing, like this guy who invests only at the lowest day of the year, he would have had, with this strategy, $173,000. Time in the market beats timing the market. So the person who invested $2,000 at the beginning of the year and did nothing got almost as good a return as the guy with perfect timing. And we know that nobody has perfect timing. So your second best strategy is to have the money in the market for as long as possible at the beginning of the year if you can, if not, investing over time. And then this strategy where you just invest in equal amounts over the course of the year, the so-called dollar cost averaging we saw in the previous slide, that one still gets a pretty good return, $140,000 versus $161 for putting in it right away versus $173 for the best possible outcome if you knew exactly when the lowest day of the year would be and you invested only on that day, which no one can do because no one rings a bell to let you know. These are all very similar, and they teach you that time in the market is better than timing the market. And this guy who tried to stay in cash and then deploy it did terribly. Well, what if it goes down a lot and never recovers? Here's a chart from Morningstar, and it shows different things like World War II, Vietnam, Black Monday. And as you see, it went down a lot, but over time, you'll get back to even and then go up. So if you invested right here, this is the start of the Great Depression. It went down, went down, went down, but eventually you would be back to even and would go up, down. Eventually you get back to positive, down, eventually you get back to positive. How long does it take to do that? There's no guarantees in life, but historically, if you had invested the top of a market and it went down, how long would it take to get your money back to even? Depends, but most of the time you would get back to even within 5 years, and 99% of the time you would get back your money within 10 years. If you look at the entire history of the stock market, there's only one period where it would take more than 10 years for you to go from the highest point through a recession or depression and back to even, and you still would not. During the entire history of the stock market, there's only one period of time when it took more than 10 years to go from the top through a recession and get back to even. So 99% of the time, 10 years is enough. Most of the time, 5 years is enough, but there's no guarantees that this will be a 5-year, a 10-year, or even a less than 4-month dip as what happened in 2020 during the panic. So you can only look as a history as a guide to remind you to think long-term, not as a guide for what to do in the short term. And in the short term, you logging into your brokerage account and looking at the blinking lights and your numbers going down, that's going to encourage you to do something like panic, which is why you shouldn't check it during the day. Odysseus in the Odyssey was going to go through this strait where the sirens, if you hear them sing, you dive over and you die. So what did he do? He wanted to hear the sirens, but he didn't want to die. So he had the sailors all plug their ears, like the earphones I'm using now, and then he tied himself to the mast and told them, don't let me out of this no matter what. And so he was able to hear the music, but he had devised a strategy where he restrained himself so that he wouldn't panic and dive over the ship. What does that have to do with investing? There's investors that do the same thing. There's a famous investor called Guy Spear who puts out a lot of YouTube videos, and you might run into him in Omaha at the Berkshire annual meetings. And he mentioned in his book, The Education of a Value Investor, that he looks at stocks and studies them, but he'll only put in a buy or a sell order after the market's closed. And why is that? Because the thing shooting up or shooting down would cause him to react emotionally, and you don't want to be emotional when it comes to the stock market and your money. You want to be rational. Numbers are rational. You have to be rational. And if you can't be rational, don't check your brokerage account and make your trading decisions during the times that the market is closed. You can put in a limit order to buy, a limit order to sell after the market's closed, and you do it when you're calm and rested and not panicking, and that will have a better effect than logging in, seeing the numbers go up and down, and buying because of FOMO that you're afraid you're going to miss out, or selling because of doom and gloom because you think you're going to lose all your money. That's not helpful to you. Mental hygiene, you want to think about numbers when you're calm, so don't do it while the market is open if you have that tendency. So Peter Lynch said, if you can add 8 and 8 and come up with a number that's close to 16, you know enough math to be a successful investor, because the stomach is a much more important organ for investing than the brain. So listen to Peter Lynch, don't panic. So I hate averages, but this is from MFSE, and it's showing the S&P 500, and the worst 10 years down 14% on average. And if you had invested $100,000, how much would you have after the worst 10 years? So on each of the 10 worst years of the S&P 500, if you had invested $100,000 after the worst year, the average after 1 year would be 117, the average after 3 years would be 148, and after 10 years, the average is 326. The problem is that you don't know when the worst year is going to be, because as I said, when it gets to the bottom, nobody rings a bell and lets you know. So you're better off just consistently investing over time, the dollar cost averaging method, as we saw a couple of slides ago, or at the beginning of the year, as we saw in that previous slide. So this is also from MFS if you want to check out their website. And this shows different things. How long do these down periods last? You never know, but this one lasted 33 months. This one lasted 12 months. This one lasted 3 months. This one lasted 1 month. That was the 2020 crash, very short, only a month. And this one lasted 9 months. So anywhere from 1 to 3 years, right? Doesn't give you much information. You don't know, as I said, so just consistently invest. That's one of the best strategies. The max drawdown from the top to the bottom, what's the worst? Well, that was during the Great Depression. You would have lost 86% of your money. That's terrible. In the 70s, the stagflation era, you'd have lost about half. Trump lived through the 70s. He claims he has never heard of the word stagflation, which is scary for a guy running the country and who thinks that tariffs are a great idea, but it is what it is. During the great financial crisis, that recession lasted 17 months. From top to bottom, it was down almost 60%. But after 10 years, you would have been up 300% had you just gone slow and steady. So during the great financial crisis, which you probably have a living memory of because it was in 2008, if you had stayed the course, you would have done pretty well. In 1 year, you would have been up 69% off the bottom. In 5 years, 178% off the bottom. And in 10 years, 300% off the bottom. So as I said, consistency beats intensity. Don't try to time the market. I mentioned that there were 14 recessions in the past 100 years, and here they are showed out for you. This is from macrotrends.net. The gray bars here are the recessions and how long they've lasted. As you see in the 2020, that was only a month. And this period here, the Great Depression, was about 10 years. So different lengths of time. But no matter how scary, how much it dropped, it eventually came back because these are share prices that represent actual businesses that have factories, that have IP like Google and Microsoft, that make things and sell things. And the stock price doesn't affect the fact that there's still a real business behind it. So keep that in mind because you are buying pieces of a business. You're not buying pieces of paper. And if you don't know how to invest in individual stocks, if you buy an index fund, you are buying all the businesses, all the best businesses, and you're keeping them in the long-term mindset. So, over time, you will do fine. So this is a more recent one. Instead of 100 something years, this is only the past 30 years. And you can see the 2008 financial crisis was long. The 2021, as I said, it's only a month. And this is the tech crash in 2000. You would have lost a lot of money there. You would have made it back just in time for the great financial crisis, a big decline, but it keeps going up. and we're over here now, and this is the Trump tariff decline, like that. But over time, it should come back, because even with Donald Trump running the country, we still have factories, we still have profitable companies like Google and Microsoft and Facebook, and companies that produced cars like GM and Ford, and companies that make things like Caterpillar and John Deere, and farmers that produce things that other countries want. So eventually it will, as here, come back, as here, come back, as here, come back, and as here, come back, even with someone like Donald Trump in the White House. So you might say, well, you seem to really like numbers. You should get a job in finance. I did work in finance and I'm retired. And you might think, that guy's too young and handsome to be retired. You're correct. I voluntarily retired because I didn't need the money and I don't want to work for that guy. Anyway, there is actually a number that will tell you how much people are panicking. It is called the VIX. And the VIX is a financial product that they sell, which is related to volatility. And volatility, when things are going up, is a sign of euphoria. Volatility, when things are going down, it's a sign of despair. But let's take a look. Volatility. So anything over 30 is usually panic. And we're pretty close to that right now. We're at 28 almost, if you round up 28. So pretty close to 30, and 30 would be panic territory. So here you go, panic, panic, boom. That one's a lot more than 30. That's more than twice that. When was that? That was that 1 month panic in 2020 when everyone was in lockdown and you couldn't leave your house and people thought the world was going to end. What about this other huge spike? Also more than twice the 30, which I consider panic. When was that? That was the great financial crisis when Lehman Brothers and Bear Stearns went bankrupt and the market seized up. No one wanted to trade with each other, and we all thought it was going to be the end of the world. Boom. So 30 is bad, and we're almost there. It's almost 28. But it's a sign that people are panicking. And as I said, if you're going to panic, you should have panicked a few weeks ago. Today is not the day to panic. Today is the day to just turn off your computer, go for a walk, and ignore what's going on in the market. Because if you look at your portfolio, if you look at your statement and you see things going down, you're going to panic and you're going to do something stupid that you regret when you're calm. So turn it off, go for a walk. The market's closed at 4. If you want to come back and check how you're doing at 4, you can do that. Then have a good sleep, wake up tomorrow. And if you're calm, before the market opens, you can decide if you want to buy or sell something, but after a good night's sleep. If you have a good night's sleep and you're still anxious and worried in the morning, don't turn on your computer, go for another walk, check back tomorrow after the market's closed. And when you are in a calm state, you can think about it over the long term. Is what you're doing now going to help you in the next 10 years? Because as we've seen historically, markets recover after about 5 years, and there's only one period in the past 100 years when you've looked at these rolling 1-year cycles where it would not have recovered after 10 years. So unless you need something in the next 5 years, don't try to time the market. There's people at Wall Street who make a living buying and selling and taking advantage of people like you. And they don't try to time the market because they can't. If there was a way for them to do it and rip you off, they would, but they can't. So if they can't do it and they do it for a living, you probably can't either. And as we've seen with numbers, with charts, the best strategy for someone like me, for someone like you, is to stay calm, stay invested, because time in the market is better than timing the market. If you invest a small amount continually over the year, the same amount all the time, that's dollar cost averaging, that is the second best strategy for someone who is not trying to time the market. And as we saw, the best strategy is investing January 1st, the beginning of the year. We already passed that. So pick the second best strategy, which is investing continually over time. And you might do fine over time. In the short run, things are bumpy, and that's why it's hard. So focus on your stomach, not your head. Stay calm, practice mental hygiene. Think about your long-term strategy. Don't make short-term decisions that are going to hurt your long-term returns. All right? So this is not financial advice. I'm not a financial advisor. I'm not your financial advisor. I'm going through my process and explain to you how I think about things. And today is a horrible day in the market. And how would I react today? And I'm going to react in a way that helps my position long term, which is to not panic, to stay invested. A few days ago, I sold enough because I had heard about these tariffs that would cover my expenses for the next couple of months so that I wouldn't have to sell at the worst possible time. But I did not sell everything and sit in cash because I can't time the market. You can't time the market. People on Wall Street can't time the market, so don't try to time the market. All I did was increase my cash buffer because I knew that every month I have to pay a mortgage, every month I have to eat. And so I wanted enough to cover that because my annual pension is a certain amount, and then I needed enough to make up the difference, and that's how much I sold. I did not go overboard because I don't want to panic, and I don't want you to panic either. Right? Future you is going to thank present you if you don't panic and do something stupid. If you did sell today, what are you going to invest in? Everything is tanking now, so you take it out, you're going to invest it in what? You're going to put it in the bank. If inflation is going up and the bank is giving you less than 1% for your money, you're still losing money, right? So just think about long-term you. You from 10 years from now, you from 15 years from now, what would they advise you to do right now? And do that. Don't listen to me. I'm not you. Everyone thinks they would know. Everyone thinks they know what they would do if they're in your shoes, but they're not in your shoes. You're in your shoes. So think about future you and ask future you what you would do when you were in your shoes. Does that make sense? Anyway, like and subscribe. I'll try to put out some more videos. There's a buy me a coffee link if you want to buy me a coffee. And just in terms of personal stuff, I did have an account with Merrill and Schwab, I believe I mentioned, and I was paying way too much for margin. So Schwab was charging me 13%, and I believe Merrill was charging me 10%. And I did search for the lowest margin. I don't plan on having any margin. I paid my margin down to 0 and I increased my cash buffer. But I thought, well, if I ever need margin, who should I go with? And I did find the two lowest ones were Interactive Brokers and Robinhood. They were pretty close, but Robinhood's a little cheaper. So I did open an account on Robinhood, and slowly I've been moving money over from my other accounts to there as I sell something. I transfer it to my bank and move it over to Robinhood, and that amount is getting bigger. And if I do ever need margin, I'm going to use Robinhood because it was the cheapest out of all of them. If you want a Robinhood account, there's a link in my bio. And if you click on that, you get a free stocks or something, and I get a referral. So if you want to help the channel, you can do that as well. But don't feel like you have to. So anyway, good luck out there. I know I've been MIA, but I've been working on some side projects that I'm not ready to reveal yet, but things are looking good. So hopefully I'll have some more time to devote to this channel. But let me know in the comments if you have other things you want to see a video on or suggestions, and good luck out there.